This video goes over the example that we went over in class this week for Chapter 20, budgeting. So I'm going to show you how to do a full budget in Excel, similar to what we did in class. So this follows the exact same information from the handout that we had in class this week. This is all the same information from your handout. So we're going to start with our sales budget here. So we start with the budgeted units, the budgeted units price. So we know that we have for budgeted units for July of 21,000, August 19,000, September 20,000, and our selling price is $17 per unit. So we'll put in 21,000 and 19,000 and 20,000, and our price is 17. And then I'm going to format these here. One thing I'm going to do is change the size of everything. So let's format that to have commas and this to be dollar signs. Okay. So then our total sales are units times the sales price. And I can copy that, change that to dollars. Our total for the second quarter, though it's the third quarter, but not going to get too worked up about that right now. So we have that for our sales budget, we're going to sell 60,000 total units and have total sales of 1,020,000. And just for formatting purposes, let's go ahead and put our bottom border on that. Once we have the sales budget done, we can go to the production budget. So we start the production budget with next month's sales. So in July, we want our sales from August. And in August, we want the sales from September. And then for September, we need October's information. So it says 24,000 for October. Then we need to know our ratio of inventory to future sales. So what's that percentage that we want? So it tells us that for finished goods, we want 70% of the next month's expected sales. So 0.7 all the way across, format that to be a percent. And while we have them selected, let's go ahead and put a border there. Our budgeted ending inventory then is the budgeted sales times that 70%. We can copy that formula across here just by dragging it. And then I need to add our budgeted sales for the month. So our budgeted sales for July are 21,000, for August 19,000, and for September 20,000. So if we add our budgeted ending inventory plus our budgeted sales, that gives us the total required units to be produced. We can carry that formula across. And now I want to deduct beginning inventory. So my beginning inventory for July will be my ending inventory for June. So it tells me that I have 16,800 units. So let's put 16,800, and I'm going to put them as a negative number. Okay. So then for August, that is our ending inventory, and I'm going to put a negative right there. So that comes in as a negative number. And then negative here. Then I add these two together, so the units to be produced and the negative beginning inventory, and that gives me the number of units that I need to produce in each month. So my raw materials budget then starts with those production of budgeted units. So from my units to be produced. And I'm going to carry those over to autofill. Next, I need to know the materials requirement per unit for my information. Go to my information and I see that each finished unit requires zero point 0.5 units of raw material. 0.5, and I'm going to carry that 0.5 all the way across, put a border. So the materials needed for production are the production budget unit times the materials requirement per unit. And I can carry that formula across and autofill. Then I need my budgeted ending inventory. So I need to look at what that requirement is for budgeted ending inventory. So it tells me that I want ending raw materials inventory to equal 20% for the next month's material requirements. Okay? So I need September times 20%. And for August, I need September times 20%. And I'm going to format that to get rid of the 0 here. So then in September, I need 50% of what I need for the October. So I've got my October right here. So I need to take that 24,000 times 0.5 because I need half a material per unit, and that's 24,000 units. Then I need to take that result times 20%. So I need 2,400. Except that if I was calculating it, that's what I would do is the 2,400. So when you're doing that Excel calculation for another problem, there you go. This tells us that we want September ending materials inventory of 1980. So I'm going to put 1980 right here. If we add those together, that gives us our total materials requirement. And then we're going to deduct that beginning inventory. So we need to get our beginning raw materials inventory. So 4,375. That as a negative number. Okay. And then the ending inventory from July is the beginning inventory for August. Throw a negative in front of that. And the ending inventory for August is the beginning inventory for September. If I add these two, that tells me the total materials that I need to purchase. Okay. Then my materials price per unit is $8 per unit. Carry that all the way across and then format that to be $1. So our total cost of materials purchases, the number of materials to be purchased times the $8 per unit. Carry that formula across and format $4. And that is the production or the materials budget. Then for the labor budget, we also start that with production units. So this last line from the production budget. And I can carry that over. Now I need the labor required per unit, so I go back to my information. So I have each unit requires 0.5 hours of direct labor at a rate of $16 per hour. Okay, so I need 0.5, and I can carry that across. And my labor rate is 16. Carry that across. Then I'm going to format that to be dollars. That way I can tell the difference between my units and my dollar amounts. So the total labor hours needed is the number of units times the labor required per unit. And then my budgeted labor cost is the total hours needed times my $16 per hour. And I'm going to need to make those two columns wider in order to see the numbers. So we'll do good formatting here. Okay. Then my factory overhead budget. So that is, if I go to overhead, it tells me that overhead is allocated based on direct labor hours. And my predetermined overhead rate is $2.70 per direct labor hour. Okay, so I start with the number of labor hours needed, which I bring from my labor budget. Total labor hours needed. And then my rate is $2.70 per hour. Carry that across and format. So my budgeted variable overhead is the number of hours needed times my rate of $2.70 per hour. My fixed overhead tells me is $20,000 per month of depreciation. So 20,000, carry that across and then format as dollars. So my budgeted total overhead is my variable overhead plus fixed overhead. And I carry that across. And I'm just going to keep going. I'm not going to break this into two videos. So I know that the best videos are under 10 minutes long, and that by still going, this is going to be longer than 10 minutes. But I'm just going to go through the entire budget instead of breaking this into two different minutes. Okay. Now we need our selling expense budget. So that starts with our budgeted sales. We can get that information from our sales budget. So I have budgeted sales of 357,000 for July and 323,000 for September or August and 340,000 for September. My sales commission percent I need from my information. Okay, sales representative commissions are 10% of sales and paid in the month of sales. The sales manager's salary is $3,500. So 3,500 for this, that's the same every month. And 10% for our commissions, 10%. So our sales commission expense is the budgeted sales times our sales commission percent. Take that across. And our total selling expenses are commissions plus salaries. Okay. Then our general and administrative expenses budget. So we have our information that we have 9,000 in salaries and 0.9% interest on our long-term note payable. So 9,000 in salaries, and that's the same every month. And then we have that 9% interest. So that's on our long-term note. So we're going to come over here and get our long-term note. The long-term note is 300,000. And then I want that to be a locked cell so that no matter what, it will take it times that 300,000 because I'm going to drag it across. Okay? And then I need 0.9%. Okay? So if you don't do 0.9%, make sure you put all your zeros in to get 2,700. Carry that across. Because I locked that loan cell, it's 2,700 in every cell. And my total expenses for selling and administration are salaries plus long-term interest, or $11,700 per month. That's the end of my general budgets, and now I get to go to my beginning cash balance, or my cash budget. Okay, so my beginning cash balance for July comes from my balance sheet of $40,000. And then I need my cash receipts from customers. So let's look at what our cash receipts from customers are. And I'm actually going to do that down here. So I have July, August, and September. So cash received from sales, cash received from accounts receivable, and total cash receipts. Okay, so my cash received from sales, go to my information and get my cash received. I see that I get 30% of sales in cash and 70% on credit. And then receivables are collected in full month following the sale. So cash received from sales is my total sales. And here's a trick. Instead of going to my sales budget, I'm actually going to take that from my selling expenses budget times 30%. And I'm going to carry that across and then get rid of. Okay. And then my cash received from accounts receivable. So in July, I'm going to receive my accounts receivable from June, and that is on my budgeted income statement. So my accounts receivable from right here, I'll receive in July. In August, I'm going to receive 70% of June's sales. So June or July sales times 0.7. And then in September, I'm going to receive August sales times 70%. So if I add those together, that gives me my total cash receipts for each month. Copy that across. Now I can just come up into my cash budget and I can bring that number up here. Cash receipts, copy that across, turn that into dollars. Okay. So now if I add my beginning cash balance plus my cash receipts, that gives me my total cash available. And even though I don't have my beginning cash balance, I'm still going to copy this formula over so it's already done for me when I get my beginning cash balance for August. Then I have my cash payments. First is my payment for raw materials. If I go to my information, it tells me that all raw materials purchases are on credit and no payables arise from any other transaction. 1 month's raw materials purchases are fully paid in the next month. So that means in July, I pay for June's raw materials. That would be in my accounts payable balance on my balance sheet. Accounts payable. But in August, I'm going to pay for July's purchases, and that is on my raw materials budget. And in September, I'm going to pay for August's raw materials purchases. Okay. My payments for direct labor, that comes from my labor budget. So I come over here to my labor budget, and I can just pick that first month and then carry it over. Same thing with my payments for variable overhead. So remember that the only reason that variable overhead is listed is because the fixed overhead is depreciation, and depreciation is a non-cash expense. So carry that. Then my sales commissions, I get from my sales budget right here, sales commission expense, and I carry that over. Then my sales salaries, that also comes from my selling and expenses budget. And then my general administrative salaries of $9,000 per month. And then long-term note interest, which we calculated to be $2,700 a month. So now we just need to fill in other amounts. So dividends. We look at our information and see when we're going to pay dividends. So we have $20,000 paid in August. Okay, so we look for August, we have 20,000. Then purchase of equipment. We're going to buy 100,000 of equipment. And then we also need one more thing in here, and that is, I'm going to add a line right in here. Income taxes. So it tells us here in our information that income taxes payable at June 30th will be paid in July. So we have our income tax payable that we're going to pay in July that we get off of our income statement, our balance sheet. So our total cash payments, we add up this entire line, so from raw materials to equipment purchases, and we take that all the way across. Okay, so the only thing we have is this loan interest. So this is that we pay 1%. So short-term notes require an interest payment of 1% at each month end. So we have 1% interest on this short-term note payable. 24,000 times 1%, and make sure it's 0.01 and not 0.1 because 0.1 is 10%. Then we take our cash available minus total cash payments to get our preliminary cash balance. Then we need to know what our cash requirement is. So it says we have a minimum cash balance of 40,000. So we have over 40,000. So now we're going to pay back to the bank that loan of 24,000. I'm going to put a negative here so that pulls over as a negative number. So the short-term note of 24,000 So my ending cash balance is all of these added together. And my loan balance at the end of the month right now is 0. My beginning balance for August is my ending balance. Then because I have my formulas in, everything will autofill, and I just need to make sure that that balance is more than 40,000, which it is. So now my beginning balance for September is my ending balance from August. Okay. So now I get down here and my cash balance is 25,620. But I need that cash balance to be 40,000. So I need an additional loan. Well, the amount of loan that I need is whatever makes that 40,000. So take that 40,000 minus my preliminary cash budget, and that gives me an additional loan of 14,800 or 380. So my additional loan balance at the end of the month is 14,380. Now I can make my income statement. So I have sales. My sales I get from the sales budget, 1,020,000. And let's make that so I can see it. Then cost of goods sold. So it tells me that my product cost is $14.35 per unit. So for sales, I sold 60,000 units times $14.35 per unit. So my gross profit is sales minus cost of goods sold. Now I need my operating expenses. So I'm just going to add together. So I'm just going to take straight from, I've got my sales commissions, sales salaries, and general administrative salaries. So I'm just going to go into my cash budget and get the sum of my sales commissions. And then you're going to love this because I want the sales salaries and the general and administrative salaries, and they're all in a row there. I can just do this, boom, and copies it down. So my total operating expenses, if I add those together, okay, are 139,500. That gives me an operating income of 19,500. Then I have my long-term note interest, which I paid for 3 months, so my note interest of 2,700. And my interest expense, which I only have 1 month of, $240. So my income before taxes is 19,500 minus my long-term note interest minus interest expense. My income taxes, it tells me that my income tax rate, if I go back to the information, my income tax rate is 35%. So I take income before taxes times 35%, gives me the amount of income taxes I'm going to pay. And my net income is income before taxes minus my income taxes. Now all we have left is the balance sheet. Okay, so for my balance sheet, I need cash. So my balance in my cash account is my ending balance from my cash budget. For accounts receivable, so remember what's in accounts receivable is 70% of sales. So my last month's sales. So I need 70% of September sales. So if I go to my sales budget and get September sales of 340,000 times 0.7. Now, what's in my raw materials inventory? So what's in that account is my ending raw materials inventory times the cost of raw materials. So let's go to our raw materials budget. We have a budgeted ending inventory in September of 1,980 units times a cost of $8 per unit. Okay, so my materials inventory is 15,840. Then my finished goods inventory, same thing. I go to my production budget and get what is my ending finished goods inventory. Okay, well, I have aimed that I'm going to have 16,800 units. Then if you remember, our cost per unit in our information was $14.35. So my finished goods inventory is $241,080. Okay. So my total current assets, I add those together. Now equipment and accumulated depreciation. So my equipment, if I go to my budget over here, my balance sheet, it says that I have equipment of 720,000. So 720,000. Then I also need to remember that I paid $100,000 for new equipment in September. So now I have equipment of 820,000. And my accumulated depreciation, well, I have accumulated depreciation of 240,000. But what else did I do? Oh, it tells me that those 3 months of fixed cost is depreciation. So I have, okay, one equals my accumulated depreciation plus 3 months of overhead. So I'm going to just add up these 3 months. And I'm going to, right before here, make it a negative number. Yep. Yeah. Oh, that. Okay. Those together. And then I get that my total assets, current plus long-term, are $1,054,920. Okay, so now my liabilities and equity. So my accounts payable. So if you remember for accounts payable, it said that we bought raw materials on credit and then pay them in the month after. So in my accounts payable is the amount of raw material purchases from my budget. So raw materials purchases, the September amount. That's what's in my accounts payable. My short-term note payable, well, that's what I took out in September for a short-term note, 14,380. Taxes payable, that is from my income statement. So I owe that $3,906 in taxes. If I add those together, that's my current liabilities. Then I have a long-term note payable. Well, I didn't pay anything on this long-term note. I only paid interest on it. So I still have that long-term note. So, and then I need common stock and retained earnings. Well, I didn't make any changes to common stock, so I can take that from here. And then you need to remember the retained earnings formula. So retained earnings is beginning retained earnings. So right here, this 60,580 plus net income minus dividends. So we pay that 20,000 in dividends. Okay, so beginning retained earnings plus net income minus dividends. So we have retained earnings. So our total stockholders' equity is those two amounts added together. So our total liabilities and stockholders' equity, add these three amounts together. And our balance sheet balances. So our budget is complete.